Congratulations, you've made it this far. This module builds on assumed knowledge acquired through the undertaking of the last module, Financial Management. In this section, we will learn about past performance analysis, performance management, and projections. The first slide, we have the objectives of the course. To familiarize ourselves with the basic financial performance ratios, to provide practical exercise to analyze these ratios and their evolution, to understand the concept of cost center performance through practical example, and to provide some guidelines on how to perform a simple financial performance analysis on your own enterprise. First, we talk about past performance analysis. The first slide, we look at financial statements. Financial statements formats differ from country to country. However, differences from one statutory framework to the other are not that significant. If you are an LTD, most probably your financial statements will resemble this template of profit and loss on the main categories. Next, we have a few learning points. A social enterprise might benefit from other types of revenues, such as grants, subsidies, or revenue from the sales of fixed assets. From case to case, these may appear in different places on the profit and loss statements and can be taxable or non-taxable. When analyzing performance, it is important to exclude these revenues from ratio computations as they are not incurred in the normal course of the business. Hence, they are not relevant in determining operational efficiency. In the next slide, we talk about important performance indicators. Gross profit, computed as sales revenue less cost of goods sold, including all variable costs. Gross profit margin, obtained by dividing gross profit to sales revenue and multiplying by 100. EBITDA, gross profit less operating expenses, and operating profit margin is EBITDA divided by sales revenue multiplied with 100. The profit after tax, also known as the net result, is EBITDA less interest, depreciation, and tax. Last but not least, net profit margin is profit after tax divided by sales revenue multiplied by 100. Important: observe other revenues are not part of the performance indicators computation, as they are a result of one-off events and/or efforts outside the business course. On this slide, let's think about what is a good gross profit, operating profit, or net profit ratio. It all depends. Profit ratios are typically benchmarked against industry standards. A 25% gross profit ratio is generally considered a good operational performance. However, it all depends how much it is eroded by operating expenses and interest. So what is the difference between gross profit ratio and net profit ratio, and why is it so large? Let's take a look together. Payroll is heavy on the enterprise, making up 63% from total operating costs. The rent is also quite important, making up 90% of operating expenses, and the company is also indebted, with interest eating up 22% of EBITDA. Let's now look on this slide at what is a business driver. A business driver is a factor that determines changes in the success and growth of a business. It can influence the business in a positive or a negative way. A business driver can also be internal or external. Business drivers can be also grouped as costs, revenue, or investment business drivers. Example of business drivers: number of products in the portfolio for the designer, number of retail shops for a retailer, capacity for a restaurant, average revenue per purchase for a coffee shop, an average room occupancy for a hostel, gross profit margin, interest rate, exchange rate, tax rate, etc. We analyze the financial performance over the 3 years using gross profit ratio, operating profit ratio, and net profit ratio. Let's proceed. What are your observations? Now, let's do it together. Gross profit margin improves significantly between year 1 and year 2, but gets back at 23% in year 3. Why do you think that is? Operating profit margin improves also between year 1 and year 2 by 9%, far less than the increase of 17% of gross profit margin, but decreases to near 0% in year 3. What do you think is the reason for this? Net profit margin improves also by 9% between year 1 and year 2 and becomes a loss in year 3. We have a few learning points. The company was quite successful in securing revenue in year 2. The exponential increase of 218% shows that most probably a new client was acquired or a new contract signed. However, this turnover could not have been maintained and it drops by 36% in year 3. The company also leverages economies of scale. Cost of goods sold increases, which is normal, as revenue also increases, but at a lower rate, only at 147%. This might mean that the company was able to negotiate some volume discounts or otherwise be more efficient with production. Payroll costs have increased by 600%. It appears the enterprise hired more and/or specialized staff to deliver on newly acquired contracts. Utilities expenses increased in line with revenues, showing perhaps increased use of production facility. It is highly possible that increased spending in marketing, a 200% increase from year 1, brought the additional increase in revenue in year 2. Interest expense remained flat, which is evidence that either the contractual terms provide that interest is paid yearly on the total amount withdrawn at the beginning of the contract, or otherwise that the company is not making any principal payments. The increase in depreciation shows that some new infrastructure was acquired. Why did the company go from such a good profit in year 2 to a loss-making position in year 3? So let's look closely. Revenue decreases, but cost of goods sold do not decrease with the same percentage, causing the gross profit margin to erode by 18%. It is possible that the new revenue would have come from new products for which the bill of material is comprised of materials which are more difficult to source or have prices very sensitive to volume order changes. It appears that the enterprise hired much more staff at their higher costs to deliver on the new contracts. The payroll structure changes, and in year 2, payroll costs become 20% of revenues, and it stays that way in year 3. Even if the payroll costs decreased by 36% in line with revenue, it is possible that in year 2, the enterprise overhired. What other scenarios are possible? There could have been a general increase in salary together with the hiring to deliver on new contracts during year 2. The company might have launched a new line of products or services in year 2, and year 2 saw the first sales materializing. The company might consider to retain part of the newly hired staff as it is expecting these sales to become mainstream revenue in the future. Observe how a change in one business driver affects performance. The company managed to boost revenue in year 2, most probably as a result of sustained marketing efforts, which shows in marketing costs, and this triggered a need to hire more people to sustain this growth. Direct cost management was pretty efficient, and cost of goods sold grew at a lower rate than revenue. Also, observe how no description of the company's activities provided, yet so many information about performance can be derived from its financial evolution alone. In reality, you will know all about the business drivers of your enterprise, but a multi-annual past performance analysis will help you determine the effect of these changes on the bottom line profitability of the business. Try to do the same analysis with your business. Determine gross profit margin, operational profit margin, and net profit margin. Then, determine structure of operating costs. Which costs hold a higher weight in operating costs and why? Take a period of 3 fiscal years, which you consider relevant for your business. Observe how these evolve over the years. What are the causes of this evolution? Determine evolution rates from year to year for revenue and all the major costs. What business drivers can you identify and how did they impact the business? But perhaps you are not an NGO and your financial statements look quite different. That is true. NGOs tend to have different reporting frameworks in most countries than LTDs. Often, social enterprises are not individual incorporated, but function as an income-generating arm of an NGO. If your enterprise is in that category, most probably your financial statements will look something like this. This format is rather synthetic, but we will start to analyze it first. Although the table does not offer generous information on which to base a performance analysis on, it does offer some important data. What are your observations? First and foremost, you would probably notice a profit from non-profit activity. Allegedly, for NGOs, grant resources need to be matched against expenses, so technically a profit would not be possible. What do you think the positive figure under non-profit activity result represents? The positive net result under non-profit activities result is not a profit per se, but the result of a timing difference between the cash in of grant money and the expenses matched against that respective installment. For example, let's assume that a grant contract provisions for a 500,000 installment to be disbursed at mid-year. The expense budget for the next 6 months is 400,000. The remaining 100,000 would be spent in the next financial reporting period. The organization would record 500,000 received as an installment as revenue, but only the portion actually spent could be reported as an expense. The remaining 100,000 presented as a profit is in fact a cash reserve which would be matched against next period's budgeted expenses. What do you think about the income generating arm of this NGO? Do you think commercial activities are important to the NGO? What comments can you make about the financial performance of the commercial activities? Do you see any potential issues with this model? Commercial revenue makes up 29% of total revenue of the organization. This is a good position to start with, but it all depends on the strategy of the NGO. Is the aim of commercial activities to generate profit and contribute to increase financial sustainability of the organization as a whole, or its purpose is different? Commercial activity profit margin is 25%. This profit margin would need to be benchmarked against industry standard to determine if it is a competitive one. However, the main flaw of analyzing commercial activity performance under this format is that it may harbor hidden costs. It is often the case that social enterprises owned by NGOs use the mother organization's resources for free. staff, space, or even equipment. In this case, 25% commercial activity profit margin is not a real one because the mother organization is supporting a part of the business costs. So, what commercial costs could hide under non-profit activities expense? We observe how the commercial activities profit margin changes if we include the social enterprises manager's salary in the overall expense. All de facto expenses made by the mother organization for the purposes of commercial activities must be included in the commercial activities expense when computing commercial profit margin. However, it is often the case that NGOs do not report all commercial activities expense under the right heading when submitting the statutory financial statements for various reasons. Even so, as management practice, for internal tracking purposes, commercial activities expenses need to be tracked separately. Failure to consider all relevant expenses might put the organization in difficulty to price the products or to accurately compute the break-even point. That is why NGOs that have a commercial revenue-making arm, even if not incorporated as a separate legal entity, are encouraged to maintain separate cost center for keeping track of commercial revenues and expense. Furthermore, the level of detail to which commercial expenses are being tracked should be the same as shown in the previous slides in displaying the case of an LTD.